Okay, so we are recording. With us is Dan Vermillion, who will be presenting for about 30 to 35 minutes, followed by a 15-minute Q&A session. Please remember to submit your questions for Dan in the chat. And now I'm going to introduce Dan, and I may not pronounce this right, but as a partner at Cades Schutte, Dan possesses extensive knowledge in complex tax planning and utilizes strategies that efficiently transfer wealth while reducing tax burdens. His practice spans both Hawaii and California. We express our gratitude to Dan for his commitment to the future of UC Law, serving as a member of the Board of Trustees, the Plan Giving Committee, and the Legacy Society. He has previously contributed as an adjunct professor in estate drafting. He is also a fellow at the American College of Trust and Estate Counsel. Without further ado, here's Dan.
Aloha, everyone. As David mentioned, my name is Daniel Vermillion. I'm a estate planning attorney partner at Cades Schutte in Honolulu. We have offices on all of the major Hawaiian islands with a kind of central office here in Honolulu. And just for everyone's question on what the weather's like, it's 81, very, very partly cloudy, light trade winds out of the northeast. Beautiful day as always in Hawaii. I started practicing law after graduating UC Law SF in the Bay Area for about 7 years, and then moved to Hawaii about 9 years ago. My wife grew up on the Big Island, so we came back and I started working for Cades Schutte and have been here ever since. Let me get things set up. The slideshow. Okay, I think we're all seeing the legacy planning tools, opportunities, and new laws. So, the presentation today, I'll go over a little bit of some basics of estate planning that probably most everyone is familiar with, some basics of tax law as it relates to estate planning, and what the main thrust of our conversation today will be on charitable planning, how you can add in charitable gifts into your own estate plan, a lot of different ways that you can add charitable gifting to your life and your estate plan. So this is the kind of basics of estate planning. So most estate plans will center around a revocable trust. It's there to take title to assets during your lifetime, essentially you transferring it from your individual name to your name as trustee. You still have unfettered control and access to the trust the trust assets during your lifetime. But what it does is it avoids the probate process at death or in incapacity. Very common. I don't know where most everyone is from, but I assume a lot of folks are going to be in California. Revocable living trust, revocable trust are very common estate planning vehicles there. Where I am in and practice mainly in Hawaii, we use revocable living trusts. Again, to avoid probate. Probate, especially in California, is to be avoided under all costs and circumstances. Just a very painful, arduous, time-consuming, every kind of superlative of awfulness that you want to avoid. In the revocable trust, like I said, you're going to be the main beneficiary during your lifetime, but then maybe if you have a joint trust with your spouse at the end of at the death of the surviving spouse, it's going to go to your children, possibly to charities, whoever you name as beneficiaries. You're also naming fiduciaries to manage these assets at death or in the event of your incapacity. You still do have a will. It's called a pour-over will. What that does, it's a little bit of a backstop for your estate plan, where if you have assets in your individual name and you pass away, the pour-over will says anything in my individual name transfer it to the trust. So that's kind of the pouring over of assets from your estate to your trust. Ideally, you don't have to utilize the will. Everything's going to either be in your trust or pass by a beneficiary designation. But again, like I said, it's a little bit of a backstop for your own estate plan. Two other kind of very common documents in an estate plan are a durable power of attorney and a healthcare directive. So in a durable power of attorney, you're going to be appointing an agent to manage your individually titled assets. And so again, kind of in your estate plan, most everything is going to be in the trust, but there are some assets that don't get into your trust. You know, something like a retirement account. You name beneficiaries after your death, but you're still the current beneficiary during your lifetime. If you lose capacity, someone is going to need to pick up the pieces and be able to assist on those retirement plans. So deciding on investments, deciding on withdrawals, things like that. That would be done through by your agent under a durable power of attorney. Life insurance commonly held in your individual name, and so similarly, that would be, if you lost capacity, dealt with by an agent under your durable power of attorney. The healthcare directive, a little bit different from the trust, power over will, durable power of attorney. It's having to do with your healthcare decisions if you are incapacitated. So, you know, mainly it's going to be end of life decisions. So if you don't have the capacity to be able to make informed decisions on your healthcare, your agent under your power or under your healthcare directive is going to be making those for you. So those are kind of the basics of the documents that would be found in most estate plans. Some tax basics that will somewhat help inform our discussion today. Estate tax, very high exemption, going higher. So it's currently 13.99 million. It's been going up with inflation for a while. It had doubled in 2017, was set to sunset at the end of 2025. The One Big Beautiful Bill signed into law in July increased the estate tax exclusion to $15 million. That's going to be for 2026 onward. And that also is going to be going up with inflation. That number is also essentially doubled for a married couple. So a married couple next year is going to have $30 million of estate tax exclusion. So they wouldn't pay any federal estate tax if the value of their joint estate was below $30 million. But, you know, all assets are going to be included: real estate, investment accounts, closely held entities like LLCs or partnerships, retirement accounts, life insurance that is in your individual name. All of that goes into calculating your gross estate. And if it's and then once you have a bunch of deductions that we'll talk about in a little bit, if those deductions only reduce your estate and still above that, say $15 million or $30 million for a joint estate, you're going to then pay federal estate tax. Some states do have estate tax. I believe 12 states plus the District of Columbia have a separate estate tax, and they're kind of all over the board on what the exemption amounts are. For Hawaii, we have 5.49. I believe New York is around $7 million. I believe Washington is around $2-3 million. So it's kind of all over the place on where states set their estate tax exclusion. So there are times where you're both subject to both Hawaii or state and federal estate tax. So given that a lot of states have lower exclusions than the federal, a lot more estates may be subject to only a state level estate tax. We find that a lot of times here in Hawaii, that people may be only subject to Hawaii estate tax, but not necessarily subject to federal estate tax. And then some income tax points to make is that anything that you donate during your lifetime, you get an income tax deduction for. I think probably 100% of folks on this call realize that, but just wanted to reiterate that. And, you know, again, people probably, everyone knows this, but if you sell appreciated assets, there's capital gains that may be due on that sale. So now we're going to start talking about how we can give and different ways to give and different ways to give to UC Law SF. So, I'll mention that a few different times. Part of this discussion is to hopefully incentivize you to make further contributions to the university. So first topic, direct lifetime gift, very, very, very straightforward. You can write a check. Obviously, probably many of the people on this call have written checks to UC Law SF. Very easy to do. It's a very straightforward process. I like to say that doing that has tangible benefits, that you're able to, give during your lifetime. You're able to, have, the satisfaction of doing something altruistic. And so I have this photo up here of this guy who is pretty happy. I don't know if he's given or receiving that check, but he's pretty happy with that check. So I encourage people to make those types of gifts. As we had just talked about, those contributions are going to be tax deductible. So if you make a cash gift, you're able to take a deduction from your taxable income. Appreciated property, say like appreciated stock and securities, you get a deduction for giving to a public charity like the university. You get a deduction for the fair market value of that gift. So, some other types of property you might not be able to, but for stock and appreciated property, you're going to be able to get a full deduction for a gift to the university. So just one little example here is that, say you have stock that's worth $10,000 basis of $1,000, meaning you bought it at $1,000 and it's appreciated. So you held Apple stock probably for not too long, NVIDIA stock probably for 6 months, where it's appreciated significantly. If you sell that stock, you're going to have $9,000 of capital gains. Assuming pretty high capital gains rates, 23.8% federal, 11% state. I'll just mention, for our state in Hawaii, we have a 7.25% capital gains rate. California doesn't have a separate capital gains rate. You're going to be taxed at your marginal tax rate, which could be up to 13%. So 35% might not even be your capital gains rate, may even be higher. But just assuming a 35% capital gains rate, you're going to pay $3,150 in capital gains tax, and then you would, if after deducting that from the $10,000, you have $6,850 to donate. Not a great thing to sell it and try to donate afterwards. Instead, if you directly donate that stock, $10,000 goes to the university. There's no recognition of capital gains, whether by you. When the university sells it, they're not going to pay capital gains, so $10,000 goes directly to them. So if you do have appreciated property that you want to contribute, then doing so gets you a full deduction for the the charitable deduction. Another kind of popular way to give to charities is by naming a charity in your trust, or maybe in your will. Like I said, most people are going to have trust. A specific gift, so that's where you name a specific dollar amount to the charity, is probably the easiest. So in the provision in your trust, you say, at my death, I give $100,000 to UC Law SF. Very easy, clear, straightforward, easy for your successor trustee to administer and make that payment. You can add them as a residuary beneficiary. So the residuary assets of your trust essentially are the remaining assets after you've paid all the specific gifts, but then you've also paid all the debts, expenses, creditors, things like that. So it's just what you have left over after you paid estate taxes, what you have left over. And so you can have a specific percentage go to a charity as well. The one, say, downside to doing that is that the residuary beneficiary that gets this percentage, because their interest is reduced by all of those expenses, they need to essentially approve an accounting from the successor trustee showing all of those expenses, saying, I started with X, after deducting Y, I have Z, and you get X% of Z. And so it just gets the charity a little bit more involved in the administration. Some people don't like having third parties involved in that. And so it'd just be something to consider if you did want to add a charity, UC Law SF, as a residuary beneficiary. This is my favorite way to give to charity. So this is either naming a charity as a specific or a residuary beneficiary of a retirement account. It's actually how I have named UC Law SF in my estate plan, and how I was able to join the Legacy Society. You know, I give every year to UC Law SF, but then a much larger chunk will go to the university at my passing. So one thing that's important to note is that by naming them as a beneficiary of a retirement plan, you're not going to have to give anything during your lifetime. It's not going to affect the balance of your retirement account. It's not going to affect how much you get out of it. It's just going to pass to them when you pass away. And so kind of similar to how you can do a specific or a residuary gift to under a trust or under a will, you can give a flat amount, a specific gift under a retirement account, or you can give a percentage. I would say giving a percentage is much easier from a retirement account versus a trust. You don't have those same kind of accounting issues to worry about. One, I guess, thing about giving a percentage is obviously, you know, the values of the retirement accounts will fluctuate over time. And so giving a percentage, you may intend in your mind, hey, I want X amount to go to the university, but by the time you pass away, it might be something much smaller as say you draw down the account in retirement. So it might be better to give a specific dollar amount. The reason why this is my favorite way to give is that a traditional IRA, you know, when you withdraw it in your lifetime, it's going to be taxable income to you. This is not a Roth. We're just talking about a traditional IRA, traditional 401k. When you withdraw it, it's going to be income taxable. When you pass away and it goes to your beneficiaries, if an individual beneficiary receives it, when they withdraw it, it's going to be subject to income tax. But if you name a charity, UC Law SF, as the beneficiary of an IRA, when they withdraw it, there's not going to be any income tax. So whereas an individual beneficiary might be receiving 60, 80, 70% on the dollar from that IRA because of their effective tax rate, UC Law SF is going to be receiving 100% of that value. So I think it's just a very powerful way to get the most amount of money to the charity in the most tax efficient method. The next topic, so we were joking about this yesterday about qualified charitable distributions being quite the mouthful. So what this is essentially, it is allowing individuals of certain ages, mostly, you know, kind of retirement ages, allowing them to make direct charitable gifts from a retirement account. And so for retirement accounts, probably most folks know that there are required minimum distributions, and those start now in the year that you turn 73. I believe in for people that were born in 1960, they'll have to start withdrawing one, so that RMD age increases to 75. And so I think that's going to be effective in 2035. But for our purposes, it's essentially 73. You have to start taking out some amount of money from your traditional IRAs or 401ks. And so just this example shows that when you turn 73, you have $1 million in your IRA, you need to withdraw 1/27.4 of your IRA, and that comes out to $36,000. If you have $10 million, that number becomes $364,000. But you have to start taking out RMDs every year. That the percentage or the fraction is going to increase, so you have to take a greater and greater proportion out every single year. And so where this qualified charitable distribution comes about is that instead of taking the RMD, you can instead just donate directly to the charity through the qualified charitable distribution. So you can have some amount, all of your RMD, if I should say that the qualified charitable distribution is limited to $108,000 per year, and so that's the limit this year. And so if your RMD is below $108,000, you can have your entire RMD go to charity. If your RMD is above that, then you can obviously have a portion of your RMD go to charity. There are a number of different benefits to having the qualified charitable distribution go directly to the charity rather than you taking the money yourself and then donating it. So it's mainly income tax. It doesn't increase your adjusted gross income. It keeps your Medicare premiums lower because your adjusted gross income is lower. It reduces your taxability of Social Security benefits. It allows you to continue using the standard deduction rather than having to use an itemized deduction. So there's a number of different ways that it really is beneficial from an income tax perspective. Because if you are taking it and then giving it, you're still kind of giving up the same amount of funds. It just gets the money to the charity in a lot more tax efficient manner for you as an individual. Next topic is a donor advised fund. So this is a little bit akin to, I say it's somewhat akin to a private foundation. You know, clients will from time to time be like, hey, should I set up a private foundation? It's like, you know, you're rich, but you're not that rich. You need a lot of money to set up a private foundation. It takes a lot to just with the administration, with the cost to set it up. It just isn't that efficient for folks that, you know, say want to donate a few $1 million. It still, that amount isn't quite enough to get a private foundation up and running. So I like the donor advised fund because you don't have to do all of that administration. You don't have to do all the logistics, all the back office stuff. You're able to donate to these donor advised funds. So what they are specific funds at community foundations, at public charities. Financial firms have donor advised funds. Schwab, Fidelity, Morgan Stanley, Merrill Lynch, all those places are going to have donor advised funds. And so you can contribute cash, you can contribute assets to the donor advised fund. And then from there, you are what's called a donor advisor. And the institution will take your advice to make distributions from your donor advised fund to public charities. And so it's essentially a way to put money into a segregated account that, in essence, you will be making the decision on where the money goes out to. So typically a client, their spouse will be the donor advisors. There usually is a written agreement with the financial institution about how the funds are going to be used, the kind of scope or areas that are going to be focused on the distributions from the donor advised fund. You can put assets into the donor advised fund during your lifetime, so you get the income tax deduction. You can put them in at your death, get a estate tax deduction. You can have your children or any other relative serve as a donor advisor during your lifetime. You can add them at your death. There's a whole lot of ways that you can structure them. The nice thing about this donor advised fund is that it qualifies as if you're donating to a public charity, because essentially everything is eventually going to go to a public charity. So you get the same deductions that you would as if you were giving directly to a public charity. One important point is that you can name the donor advised fund as the beneficiary of the IRA. But you can't have the qualified charitable distribution go to the donor advised fund. So you can pair up both the IRA beneficiary designation with the donor advised fund, and then you can your children or spouse or whomever after your passing can continue on that legacy that you may have already established through the donor advised fund. So the last topic we're gonna go over, save the most complicated one for last. So I hope you bear with me on it. But I think it is a very powerful tool that bears discussing in some depth. It's called a charitable remainder trust. So there are a couple different kinds. The main kinds are charitable remainder annuity trust and a charitable remainder unitrust. The annuity is where you get a set dollar amount back, and the unitrust is where you get a percentage of the year-on-year assets back. And so it's generally going to be used when someone has charitable intent, but doesn't necessarily want to part with the assets completely outright. They maybe have what typically you'll see it with an appreciated asset that they want to sell. They want to get some benefit back with their lifetime, and they want eventually a charity to get the remaining assets that are in the trust. And so that's why it's called a charitable remainder trust. So the person putting in the assets will receive that annuity or unitrust amount back for either their lifetime, can be their lifetime and their spouse's lifetime, or for a term of years. And so that comes out every single year. You put your asset into the charitable remainder trust. Almost always is going to be an asset that you're going to sell. The sale inside the charitable remainder trust is not taxable because it is a charitable trust. So you put an appreciated asset into the trust. The trust sells the asset, and there's no income tax, no immediate income tax from that sale. So essentially, you've liquidated this appreciated asset. It can be real property, it can be business, it can be, usually you'll see it with stock and securities. You liquidate it, and then you reinvest it in a diversified portfolio or some diversified assets that allows you to get this income stream. You can have successor owners. So if you say for your lifetime, you can then have another person's lifetime, maybe your children. It's going to be limited to the lesser of 20 years or their lifetime. So probably you usually terminate at 20 years into the child's lifetime. Whatever the term of that charitable remainder trust is, it can terminate at your death, or it can go on, as I just mentioned, for other beneficiaries. At that termination debt, then whatever's remaining in the charitable remainder trust is going to go to the charity. So that's where kind of the charitable remainder trust name comes from, because the charity gets their remainder. When you are calculating what is going to be that annuity amount, what's going to be the unitrust amount, they use current interest rates to determine what you're allowed to get back. The charity must have at least a 10% remainder interest, essentially actuarially calculated based on current interest rates, based on your life expectancy, if the term is on your life. What I will say is that the relatively high interest rate environment that we're in right now actually results in a higher annuity or unitrust payment to the individual beneficiaries, or it can allow for a higher payment if you wanted to get a higher payment. So they have become more attractive than they were in, say in 3, 4, 5 years ago, just with the general rise in interest rates over that time. Another very important component of charitable remainder trust is that when you make that initial contribution, that's going to result in a charitable deduction, a current charitable deduction to you. And so that's where that kind of 10% remainder interest, that going to charity, because essentially actuarially calculated, at least 10%, it can be more, goes to charity, you get a income tax deduction for that. So another absolutely great feature of a charitable remainder trust. And then when those payments go out to you every single year, either the annuity trust or the annuity amount or the unit trust amount, though that's kind of where the recognition of income tax will come about. So you receive a payment from the trust for your annuity amount, for your unit trust amount. Whatever income that was earned by the trust during that year, that's going to be allocated to your payment. If your payment is in excess of that, then any tax-free interest is going to be allocated to it. If your payment was still in excess of that, then any capital gains from that initial sale is going to be allocated to your payment. So every year you will be getting a little bit of income recognition from the income that was in the trust, maybe some tax-free interest, maybe some capital gains by that initial sale. But it's much better to have a little bit of income recognized every year than a large amount of income recognized in that year one. So this is just a little example of how this might work. So here we have a 75-year-old that is going to be contributing $10 million in Apple stock with a $1 million basis to this charitable remainder trust. So they will be getting a charitable deduction of $3.8 million and receiving a payment back of 7.41%. So say you have the $10 million that goes in, you sell it, you have $10 million reinvested, you get into payment of $741,000 every year for the rest of your life. And then at death, then that's when any remaining assets go down to charity, to the listed charity in the charitable remainder trust. So kind of contribute the assets, you sell, you get this immediate charitable deduction, and then every year you're getting this annuity stream. So it allows you to kind of free up this concentrated position and then over time receive income from that position once it's been reinvested, and then probably a little bit of capital gains moving forward. Just one reason why you may want to use a charitable remainder trust versus just kind of selling the assets and getting the investment proceeds back in. And so same situation, you have $10 million in Apple stock with a $1 million basis. So first example would just be you just sell it, you get your $10 million in net proceeds or in proceeds, but then you're going to have to pay tax on that. And so again, kind of this 35% and plus in capital gains. So from the $10 million, you have $9 million of capital gains. You're going to have to pay $3.3 million in capital gains tax. So at the end of the day, once you pay the tax on it, you net. Oh, you would net $6.7 million. Sorry, not $5.7 million or 3.3 subtracting from 10. But 5% of that is going to be on the net amount once you've paid tax. Versus if you make this contribution to the charitable remainder trust, they sell your $10 million stock, you don't pay any tax on that in year one. So the income on that is same 5% is going to be much larger than if you had sold it outright and had paid the tax. So overall, you're going to be likely receiving more income if you use a charitable remainder trust to diversify and liquidate a concentrated position. So it has a nice charitable component to it, but it also has, I think, a very nice income tax and overall financial component to it as well. So it really melds, kind of personal preference, personal gain with charitable intent. And so it's a great vehicle for people to look at that are in the, enviable position of having concentrated, highly appreciated positions in stock or in other assets. So last slide to go over is just a pitch for the UC Law San Francisco Legacy Society. So one way that we can give back is to put UC Law SF into our estate plans. And so you don't have to have a specific amount. It's just you just need to have written confirmation to the university that you are making a gift to the university in your estate plan. You can do this online. You can let David Sweet, whose contact information is down below. If you already have the university in your estate plans, just let them know, and they would love to hear from you on that subject. So I highly encourage you to do so. Like I said, I've done it. I've done it in my retirement plan, so it's absolutely painless to me, and I think it helps support a university that personally has given me so much, given me the opportunity to be where I am today. So I'm forever thankful for that, and try to give back as much as I can. All right, thank you.
Well, thanks, Dan. What a great presentation. I hope everyone enjoyed it. Now is the time for the Q&A section of the webinar. If you would please submit questions. I have, I think, two ways to see them. One is in the chat, and one is in a Q&A functionality. Someone sent me a question through that. So it'd be wonderful if you could send your questions through. And then once we get through the questions, we can start having people unmute themselves and ask questions to Dan directly. So thanks for the questions in advance. I do have one here, Dan. If you have multiple IRAs, is the limit 108,000 per IRA?
No, unfortunately, yeah, it's total. So essentially aggregated for where you can do, and I believe you can you can do entirely from one than the other, but yeah, it would be in total. So 108,000 that you could do. It's not per account.
Great, thanks. Looking for more questions from anyone? Here we go. Here's a few. Can you make a QCD from a SEP IRA?
I believe, yeah, you should be able to do that. I don't believe there are any restrictions in it.
Okay, good. Is a 403(b) treated the same as an IRA?
For QCD purposes, I'm not sure. I can look at that and let you know. I do not, yeah, unfortunately know the answer for that one, but Tom, I can get back to you on that one.
Great. Definitely looking for more questions. Anyone want to chime in? Please do. We're looking for just anything on the topic that Dan's covered, or anything else you want to ask about.
And let me. I think my stuff is still up on the screen. What I say, and then also, you can contact David, but my contact information is up on the screen. So, if you wanted to discuss, generally any aspect of what I presented, if you wanted to bounce ideas off on your estate plan, whatever, you can absolutely feel free to reach out to me. More than happy to discuss any aspect of your estate plan, any aspect of any charitable gifts that you're thinking about. Like I said, most every part of what I presented on is pretty straightforward. I would say the charitable remainder trust is probably the most complicated aspect of it, but like the beneficiary designation for your IRA, you can get some places. I'm pretty sure like Schwab, you can do those online. You know, a lot of places it's pretty easy to change beneficiaries. Changing changing your trust or your will, I would generally recommend having your attorney do that. I would, for the donor advised fund, that's fairly easy to set up with a financial institution. And then the charitable remainder trust is probably the most complicated one that would involve a fair amount of discussion to where what you're intending, what assets are going to go into the trust, the terms of the trust, and all things like that.
Great. Thanks, Dan. I have some more questions. One question, can you explain the changes on deductibility of charitable contributions in the BBB, which must be the Big Beautiful Bill? So explain.
They continued. So there's still the 60% of AGI for cash contributions to public charity, and there's still the 30% adjusted gross income deductibility for appreciated property, securities, long-term capital gains investments. So those I would say for this conversation is probably like the most germane for that, but they have continued on.
Great. I have another question. I'm not sure this is covered from what you were talking about, but here we go. How have federal budget changes affected UC Law SF, if at all?
Yeah, I would. I met with Dean Fagman. He'd probably be the best person to talk to this subject, but I think the university is fairly well protected. I believe they haven't been subject to any of the I guess you'd call it tactics against you know, Harvard, Penn, a bunch of different Ivy League colleges. But you know, that's not to say, you know, it's still obviously early on in this administration's term, and a university that celebrates diversity had Kamala Harris as our, you know, most prominent alumni. And he also mentioned that the head of DOJ civil rights is the same attorney that was the primary attorney on the you know, name change litigation. So that's not to say we may not be in the spotlight of US DOJ at some point in time in the presentation, or not presentation, but in the future. But I do think that the university is fairly well insulated and gets its majority of its funding from obviously from student tuition, but then also as a separate line item in the California's budget. But yeah, like that's the extent of what I know. You know, anything or any presentation you can be a part of that Dean Fagman is doing, I think he is incredibly knowledgeable, incredibly you know, forward thinking on where things may go with the university and where he wants to go with it. I would encourage you to attend those.
Thanks, Dan. One more. If an IRA is left entirely to charity, does the amount paid out by the custodian count in calculating the trustee's fee?
That's a great question. Generally not. Generally, trustees' fees will only be based on what assets come into the control of the trustee. And there isn't much for a trustee to do. And sometimes like a custodian of an IRA won't deal with the personal representative, won't deal with the trustee unless they are the beneficiary. They're, you know, they'll say, oh, thank you for letting us know that the person's died. Do you have the contact information for the beneficiary? And then they just go straight to communicating with the beneficiary. So there's very little that can be done to, or that's very little that needs to be done by a trustee for those. I would generally recommend not having retirement plans flow through a trust. If circumstances call for it and it's appropriate, then it can be done. But just administratively, it is far simpler for a host of different reasons to name individual beneficiaries, whether it be charities or individual, like living people, individuals, just because of it's a very seamless process for the custodians to distribute the assets to the named beneficiaries.
Great, thanks. That's the questions that we have here. We have about 10 minutes left. If anyone wants to ask questions live, I believe I put it together so that you could unmute yourselves. Any questions? Oh, someone raised their hand. Okay, Ellen? You, no, she's muted there. No, okay.
Looks like John raised his hand as well.
Sure, yeah, let's go.
Dan,
John?
I don't
Yes.
have a question, Dan, but I just want to say thanks. I thought it was a very compact, well put together, and well presented education. So I really appreciate the time you put into this, and thank you for doing this.
Yeah, of course. No, very, very happy to present, and greatly appreciate everyone that came and listened in. And I just hope that you got something out of it, spark some ideas in your mind for how you can include UC Law SF in your estate plan. Obviously a great cause that I think is very important to all of us, and hopefully all of us are very fond of.
Great. Next guest. No, it's not popping up. Anyone else have more questions? I'm allowing people to talk, so please feel free to ask. Okay. Great. So then I'll make my thank yous and my little pitch. So of course, thanks everyone for questions. Do we have more?
Hi, this is
Jerome.
Jessica. Can you hear me?
Yes.
Yeah, we can hear you.
Hey, my question was on the Charitable Remainder Trust. Is there sort of a minimum value that's sort of industry known to sort of before you start going down that rabbit hole as a possibility?
Great question. It's a little bit, like I said, similar to the kind of private foundation, donor advised fund, but I don't think it's as significant. The logistics of a charitable remainder trust are nothing compared to a private foundation, both in the establishment and the ongoing administration. I would say, depending on who you work with and how their kind of hourly rate, right, and what it's going to cost for them to draft, I would say the cost to set up a charitable remainder trust would probably be in the $5,000 to $10,000 range, but that could change based on hourly rates and whatnot. And so if you were, had 500,000, maybe $1 million, I think you're really going to start reaping the benefits. If it's like $100,000, it probably isn't worth it. You aren't there. There just isn't the tax benefit there to doing it to set it up or to justify setting it up.
Thanks, super helpful. And I'll echo what John said. Really appreciate the great presentation. Thank you.
Of course.
Okay, I think we have someone else here. I'm trying.
Yeah, it
anyone?
was Jerome Pandel. I put it in the Q&A, but I just was curious. I saw an article about I think it was, and not that I personally support this, a 100% tax deduction for charitable contributions to organizations that give out scholarships, and this includes universities. I was curious if Dan had heard anything about that and whether that represents a benefit of some kind to the college, even though the reasoning behind it isn't necessarily directly applicable, like the purpose of the change in the tax law.
Is this more of like the kind of school voucher stuff?
Yeah.
Okay.
And I want to make clear that, I was curious because they said they couldn't really delineate scholarship granting organizations as different from just voucher programs versus universities.
Right.
So
Right.
I was curious whether there's any direct benefit to law school donations in that regard.
Yeah, I haven't been I haven't read up too much on kind of how the even just like the logistics. I think that's a complicated structure in how you get it. And I know it's I don't want to say limited, but it's somewhat limited to, I think you would be looking to use it for your own child. So I don't know if we could even donate to the school and get the full deduction or get the credit for it. I haven't heard the university looking into it. I don't know if it would even be feasible. If it was feasible for the university, whether the administration would support it as a matter of policy, of public
Right.
policy, not wanting to support that. I think even if we somehow qualified or we could qualify for it, I don't think that that the administration would probably want to support that as a matter of public policy.
The only reason it came up as I thought of it is it's as a specific driver of scholarship dollars, and given that it does, I think, limit it to a $1,700 donation, I was like, that's a good pitch to make to some donors at the not super high level of like, hey, you can put $1,700 directly towards scholarships and it goes right back to you. So
and I don't know if again, like I said, I don't have I haven't read too much on the specifics of it. If the university would be able to set up something like that, or if it have to be a subsidiary, or if it have to be
period. Should I drop the humpies off? ?
Yeah, whether we could use the current structure of the university, or if it needs a subsidiary, needs another one. I think a lot of different logistics even to contemplate, but I haven't heard any discussion on it. And I like I said,
putting aside the policy controversy, inevitably sometimes these policies are for one purpose and wind up serving another. So
yep. So yeah, it could be possible. I just don't know if I just don't know enough about the logistics if we could use it for our contribution to the university for scholarships for other students. I just don't know.
Okay, so we have time for 2 more questions. Jeffrey Law, if you would unmute. Hello? No? Okay. Anyone Anyone else?
And then I just, Sarah had asked if I could put the contact or my contact information in the chat. So I just added my work email, my desk phone number. So calls directly here.
Great. Very helpful. Okay, if there are no more questions, then let's wrap this up. First of all, I'd like to thank Dan for a great presentation. Clap, clap, clap. Really great job, very informative, and thank you so much for taking your time to talk to people at UC Law and provide this extra enrichment service. We really appreciate it a lot. Thanks, Dan. Okay, I just want to re-mention how grateful we are for the generosity of the Legacy Society members. They're amazing. If anyone wants to join, you can reach me, and my email is sweetdavid@uclawsf.edu, which I can put in the chat. And then, okay, right. So if you have any questions about estate planning, please contact Dan. Dan put his information in the chat. If you're interested in joining the Legacy Society or want to know more about it, please contact me. And let me just put my email in the chat. Oop. Okay. Any final thoughts? No, I think we're good. Okay, well, thanks everyone for coming. And it's been a very successful group. You guys have been wonderful, and look forward to doing this more.
Excellent. Thank you, guys.
Thank you.